Rocket Lab fell 8.2% today, scoring a 57 hold. Capital expenditure surged by $40 million as hardware scale-up bottlenecks their near-term launch margins. Space is a cold, physical, hardware-constrained environment where software simply cannot fix a bad weld. Our full teardown reveals whether their upcoming Archimedes engine production can actually save this balance sheet. Rocket Lab sits as a Tier 3 emerging play in the AI supply chain, the space launch layer, currently in an early phase. Rocket Lab's $69 billion valuation hangs entirely on a single physical constraint: the structural mass fraction, the ratio of empty vehicle weight to propellant weight, of its unproven carbon composite Neutron rocket. While Wall Street treats this stock as a sentiment proxy, the underlying engineering reality is far more volatile. Electron is a proven vehicle. Its Rutherford engine uses a brushless DC motor and lithium polymer batteries to drive its propellant pumps instead of a complex gas generator. This electric pump-fed cycle, a rocket engine cycle that uses electric motors powered by batteries to drive fuel pumps rather than burning a portion of the propellant, simplifies the plumbing. However, it caps payload capacity to 300 kilograms to low Earth orbit. To scale up to the 15,000 kilogram capacity of Neutron, Rocket Lab has to abandon this elegant electric cycle. They are transitioning to the Archimedes engine. Archimedes is a liquid oxygen and methane engine utilizing a gas generator cycle, an engine cycle where a small portion of fuel is burned in a pre-burner to power the turbopumps before being exhausted overboard. Archimedes targets 1 meganewton, 100,000 kilograms of force, of thrust with a specific impulse of 350 seconds. Specific impulse, or ISP, the metric of rocket engine efficiency measured in seconds, representing thrust delivered per unit of propellant consumed, is the ultimate physical benchmark. For comparison, SpaceX's Merlin 1D engine delivers 84 kilograms of force per unit of propellant, while their Raptor engine pushes past 380 seconds. Raptor achieves this using a highly complex full-flow, staged combustion cycle. By opting for a simpler gas generator cycle at 350 seconds of ISP, Rocket Lab is trading raw thermodynamic efficiency for manufacturing yield. But the real engineering bottleneck is the carbon composite fuselage. Neutron features a unique, hungry hippo fairing, the protective nose cone that remains permanently attached to the first stage rather than being discarded in flight. This design reduces operational costs, but increases the thermal load on the structure during re-entry. Unlike SpaceX, which transitioned Starship to cheap stainless steel, Rocket Lab is sticking with advanced carbon fiber. Carbon fiber offers an exceptional strength-to-weight ratio, allowing Neutron to maintain an ultra-low dry mass. But carbon composite structures are notoriously difficult to autoclave, the high-pressure thermal curing process used to solidify composite materials at a 5-meter diameter scale. If Rocket Lab experiences delamination, the structural failure where composite layers separate under thermal or mechanical stress, the entire Neutron timeline slips, risking their $2.2 billion backlog. While Wall Street panics over short-term index shifts ahead of the $1.75 trillion SpaceX IPO, the real story is where Rocket Lab sits in the hardware capital expenditure cycle. We are in the early phase of the space infrastructure build-out. Capital is flowing from speculative software concepts directly into physical launch capacity and satellite constellations. Rocket Lab's Space Systems division now accounts for over 50% of its total revenue, driven by a $515 million Space Development Agency contract. This shift from pure launch services to vertically integrated spacecraft manufacturing is a high-margin pivot. However, executing on this backlog requires a flawless supply chain. Rocket Lab operates in the space launch layer of this infrastructure cycle, currently positioned as a Tier 3 supplier. This means while their consumer engagement is high, their actual industrial moat is still under construction. The acquisition of Mynaric for laser optical communications, the technology that uses infrared light beams to transmit data between satellites at gigabit speeds, shows Rocket Lab is building an integrated hardware stack. But this integration introduces severe supply chain bottlenecks. They are no longer just buying raw carbon fiber. They are sourcing specialized optical components and space-grade semiconductors that are subject to strict export controls. The market's 8.23% drop today to $110.08 reflects the fragile premium placed on this early-stage execution. When the market experiences extreme fear, speculative premiums evaporate. Rocket Lab has a proven track record with 50 Electron launches, but Neutron is an entirely different class of physics. If SpaceX Starship achieves its target of $100 per kilogram to orbit, it will completely commoditize the launch market. Rocket Lab's defense is not cheap mass. It is dedicated, high-precision orbital insertion. They are building a bespoke express service, not a bulk cargo freighter. But until the Archimedes engine completes its full-duration hot-fire testing, Rocket Lab remains a pre-profit company with a negative 7-cent loss per share in its latest quarter, burning cash to build heavy-lift infrastructure. The engineering reality is that Rocket Lab is building SpaceX's only viable commercial competitor from scratch, but any thermal cycling failure on the Archimedes test stand will rapidly close their 2 to 4 year moat window. Quarterly financials showing modest revenue momentum for Rocket Lab. By Q4 2026, restrictive monetary policy and tariff-driven capital flight will compress Rocket Lab's valuation multiple by 30%, overriding its current 63.5% revenue growth. While Wall Street treats the upcoming June 12 SpaceX IPO as a rising tide, the underlying macro liquidity tells a far more dangerous story. Today, Rocket Lab plunged 8.2% as macro-gravity reasserted itself. The macroeconomic environment is not a passive backdrop, it is an active, aggressive force. With the Federal Reserve rate sitting at 3.63% and the 10-year yield climbing to 4.47%, the cost of capital is choking highly speculative, pre-profit enterprises. The yield curve is normalizing with a spread of plus 0.42%, signaling that long-term debt is demanding a premium. Even with low CPI, inflation at 0.6% YoY and unemployment at 4.3%, two Federal Reserve officials have openly warned of potential interest rate hikes. Prediction markets on CalSure now price recession risk at 6.6%. For a company scaling its Neutron rocket program, high interest rates are a direct tax on engineering execution. Rocket Lab is currently positioned at the early, highly speculative phase of the CapEx cycle. AI infrastructure capital flows through a strict pipeline, first to silicon design, then to advanced packaging, then to servers, and finally to orbital edge nodes. Rocket Lab sits at this final, speculative layer. Their $2.2 billion backlog is heavily dependent on government defense spending. However, the macro wave is turning. Trade policy has become highly volatile. Recent headlines warning of a trade war over Greenland and new tariff threats have triggered the worst market stumbles since April. For Rocket Lab, tariffs represent a dual threat. They inflate the cost of imported aerospace-grade materials while simultaneously tightening global capital markets. As mortgage rates remain stubbornly high, public policy is shifting away from speculative funding toward domestic defense resilience. If trade policy forces a broader market de-risking, Rocket Lab's high beta of 2.50 means its valuation will be dismantled first. The geopolitical landscape is no longer a theoretical risk, it is a physical barrier to entry. The global space economy is projected to grow from $630 billion today to $1.8 trillion by 2035, but this growth is highly polarized. Rocket Lab operates in a bifurcated supply chain where export controls restrict access to key international markets. The ongoing US-China tech war prevents Western launch providers from servicing Asian satellite constellations, capping Rocket Lab's addressable market. Furthermore, regional conflicts threaten the delicate supply chain of specialty gases and high-grade carbon fibers required for the Electron rocket. This geopolitical friction directly threatens Rocket Lab's high engagement mode. This mode is temporarily protected by their defense contracts, but it faces an expiration date. By 2029, SpaceX Starship will reach commercial scale at an estimated $100 per kilogram to LEO, completely breaking Rocket Lab's launch economics. Rocket Lab's current launch services will be rendered obsolete unless they rapidly transition to high-margin spacecraft manufacturing. Wall Street is currently blind to this transition timeline. Retail investors are buying the social narrative, viewing Rocket Lab as the only public proxy to ride the coattails of the $1.75 trillion SpaceX IPO. This is a classic narrative trap. The capital rotation we are witnessing today is not a sign of sector health, but a flight to liquidity. While speculative capital temporarily pumps space stocks, the smart money is rotating out of high-beta assets as tariff uncertainty looms. Rocket Lab's 5.8% short float shows that institutional bears are already positioning for a post-IPO reality check. The social enthusiasm for space-based mesh networks cannot outrun the reality of a pre-profit balance sheet. Rocket Lab is building SpaceX's competition from scratch, but they are doing so in a high-rate, high-tariff environment that SpaceX never had to endure during its early scaling phase. Do not let the retail hype blind you to the structural capital squeeze. Sell the SpaceX IPO momentum before macrogravity pulls Rocket Lab's valuation back to Earth. Rocket Lab reported earnings per share of negative $0.07, beating the Wall Street estimate of minus 0.08 by 14.1%. A solid beat that signals strong execution. Rocket Lab, space launch, is trading below its 20-day average at 1. Part A Management's headline this quarter is crystal clear. Rocket Lab is the only vertically integrated space company outside SpaceX. That phrase appears in the earnings call, the press release, and every investor slide deck. It's designed to make you feel two things. First, that RKLB is the default alternative for investors who want space exposure but can't buy SpaceX yet. Second, that the company is diversifying beyond launch into higher-margin spacecraft and defense contracts, so you don't have to worry about being crushed by Starship's price war. But here's the thing about PR language. It's not about what it says. It's about what it doesn't say. Notice how they never compare Neutron's cost per kilogram to Falcon 9's? That's because Neutron isn't flying yet, and when it does, SpaceX will have had 2 more years to drive Starship's marginal cost to near zero. The vertically integrated label is a shield, not a moat. It lets them pivot the narrative away from launch economics, the one area where SpaceX is already lapping everyone, and towards spacecraft margins, which are real but still unproven at scale. Now let's talk about the insider activity. Over the past 90 days, insiders have sold $66.9 million in stock. That's not a rounding error. 2 names stand out. CFO Alexander Slutsky dumped $11.8 million, and Chief Strategy Officer Arjun Kampani sold $10.2 million. In hardware engineering terms, that's a thermal runaway. When the financial and strategy leads are liquidating at this magnitude, it's not about portfolio diversification. It's about risk transfer. Historically, this pattern precedes either a capital raise or a major execution hurdle. Think Neutron's first flight slipping into 2027, or the SDA contract hitting a technical snag that delays revenue recognition. The lab hears this. Management is selling the vision of vertical integration to Wall Street, while the people who know the engineering reality are selling their shares to you. Part B, let's look at the EPS beat. The company reported a 14.1% beat on the quarter, extending a 3-quarter streak with an average surprise of 19.8%. That's impressive, but here's the catch. These are non-GAAP numbers, and the beat is coming from spacecraft revenue, not launch. Spacecraft margins are higher, but they're also lumpy. One SDA satellite delivery can swing a quarter. The real story is in the R&D line. Rocket Lab spent $271 million on R&D last quarter, 45% of revenue, up 55.2% year-over-year. That's not a typo. For a company that's still pre-profitability, that level of R&D intensity signals one thing. They're betting the farm on Neutron. But here's the engineering reality check. Neutron's Archimedes engine is still in test firings, and the Hungry Hippo fairing design, where the payload fairing stays attached to the first stage, has never been flown. That's a massive technical risk. If the fairing doesn't separate cleanly, the entire stage could tumble. And if Archimedes underperforms on thrust, Neutron's payload capacity drops, making it less competitive against Falcon 9. The PR narrative glosses over this. They call it innovative, The lab calls it improving. Now, let's talk about the institutional flows. Institutions hold 58.9% of the float, and the top 5 holders have been buying. That's the bull case. Smart money sees the SDA backlog and the SpaceX IPO halo and wants in. But here's the PR filter. Institutions are buying the narrative, not the execution. They're pricing in Neutron's first flight as a binary catalyst, but they're not pricing in the risk that Starship's cost curve could make Neutron obsolete before it even launches. Dig into the 10 QS risk factors section, and you'll find the real story. The company added 39 risk factors this quarter, up from 32 last quarter. That's not a typo. They're flagging everything from Neutron development timeline delays to government contract concentration risk to competition from SpaceX. But here's the kicker. In the MD&A section, they use the phrase, "We may not achieve our targeted launch cadence," 3 times. That's PR code for, "We're not sure we can hit our numbers." And yet, in the earnings call, they called the quarter a testament to our execution. What management is saying is, we're the next SpaceX. What the lab hears is, we're burning cash to build a rocket that might not matter if Starship works. The 90-day checkpoint is simple. Watch the R&D line. If R&D as a percentage of revenue drops below 40%, it means Neutron development is slowing down, either because they're running out of cash or because they're hitting technical snags. And watch the 10 QSMDNA for the phrase launch cadence. If that phrase disappears or gets softened, it means management is preparing for a delay. If either of those things happens, the bull thesis breaks. The lab's verdict. Rocket Lab's PR is a masterclass in selling the future. But the future isn't built on press releases. It's built on Archimedes engines that fire on time, fairings that separate cleanly, and a launch cadence that doesn't slip. Right now, the only thing that's separating on time is the insider's stock. The momentum breakdown for Rocket Lab. RSI sits at 42, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. We look at Rocket Lab through a cold, physical lens because space is a hardware-constrained environment where software cannot fix a bad weld. The bull case rests on 2 structural pillars: their complete vertical integration and the impending SpaceX initial public offering, the first public sale of shares in a company to institutional and retail investors, which will act as a massive sector-wide valuation tailwind. First, Rocket Lab is not just a launch company. They are a space systems manufacturer with a $2.2 billion backlog, proving they can capture the high-margin satellite bus market. Second, they have commoditized small satellite launch with the Electron rocket, powered by the Rutherford engine, the world's first entirely 3D-printed, electric pump-fed rocket engine that utilizes electric motors and lithium polymer batteries to drive its propellant pumps rather than a traditional gas generator. This architecture eliminates complex turbomachinery, lowering manufacturing costs, and allowing Rocket Lab to scale production like a consumer electronics company. As they transition this expertise to the larger Neutron rocket and its Archimedes engine, a reusable methane liquid oxygen engine designed for rapid turnaround, they are positioned to capture the massive capital flowing into the Space Development Agency constellation, which is a military network of low-Earth orbit satellites. But here is what breaks the bull thesis. Execution risk on the Neutron rocket is massive, and Rocket Lab is burning capital in a high-interest environment where the Federal Reserve's 5.25% policy rate makes debt financing brutally expensive. If Starship achieves its target of $100 per kilogram to orbit, it will completely commoditize the launch market, rendering the medium-lift Neutron obsolete before its first commercial flight. Furthermore, Rocket Lab is trading at a forward price-to-earnings ratio, a valuation metric comparing share price to projected earnings per share, of negative 15,141.7 times, representing a highly speculative valuation that offers zero margin for error. The technical setup is already flashing warning signs, with trading volume declining 21.7% below its 20-day average, indicating that institutional interest is actively drying up. If they experience a single manufacturing defect or supply chain bottleneck with the Rutherford engine, their entire launch manifest collapses, driving customers straight to SpaceX's dedicated rideshare programs. Let us ask the one question that Wall Street analysts are too polite to bring up on earnings calls. How does Rocket Lab maintain its gross margin, the percentage of revenue remaining after subtracting direct production costs, when rising tariffs on aerospace components and strict U.S. export controls on China origin parts are actively driving up their bill of materials? The lab's answer is that Rocket Lab is playing a dangerous game of customer concentration. While their space systems division accounts for over 50% of total revenue, their backlog is heavily reliant on a few key government contracts, specifically the $515 million Space Development Agency contract. From a public relations perspective, management is using the narrative of Space Uber, a rideshare model where multiple small satellites share a single rocket, to mask the fact that they are facing intense pricing pressure from new competitors like Relativity Space. If the Department of Defense restructures its satellite procurement timeline, Rocket Lab's revenue path evaporates, and their high fixed-cost manufacturing facilities will turn into margin-destroying liabilities. We must be intellectually honest about our own positioning. On June 1st, 2026, we issued a buy recommendation at $123.78, and with the stock now trading at $110.08. We are down 11.1% on that call. Our outlook for Rocket Lab is highly conditional, reflected in our current AI score of 57 out of 100, which signals a neutral near-term stance with high execution risk. If Rocket Lab successfully launches the Photon-based lunar pathfinder for its U.S. defense customer in the next half year, proving its end-to-end satellite-as-a-service model, the stock will break through its horizontal resistance, a price level where selling pressure historically prevents further increases, of $150.23 to test yearly highs of $151. Conversely, if Neutron's first flight is delayed past 2026, or if Rutherford engine supply chain snags stall the launch schedule, the stock will break down past its immediate support, a price level where buying interest historically prevents further declines, of $105.47 and plunge to key support at $86. The lab's call: we expect a period of near-term consolidation within the current wedge pattern, a technical chart formation where price fluctuates between converging trend lines, as the market waits for concrete Archimedes engine test data, making the $86 support level the most likely accumulation zone before any long-term breakout. Rocket Lab's Q3 backlog hit $1.2 billion, yet margins still bleed at 18%. That's today's core signal. Is the bull case or bear case stronger for RKLB right now? Drop your thesis in the comments. This isn't financial advice. We're here to break down the engineering and economics, nothing more. Do your own research. Past performance doesn't guarantee future results, and never trade on a YouTube video alone. We'll see you in the next teardown.